Hello everyone. In today's video, we will discuss various accounting principles, accounting standards, accounting cycle, and the basis of accounting. The business today is large in size and complex in nature. There are various groups who are interested in the performance of the business, such as shareholders, debenture holders, investors, employees, and consumers, etc. Accounting, in this way, is required to report and represent the facts of the business in such a way which can meet the varied requirements of various groups. And therefore, it is necessary that the language and the terminology of accounting is standardized so that there may be uniformity in the presentation of the books of accounts. The idea requires scientific study, analysis, and presentation of accounts. So, to bring the uniformity in the books of accounts, we are going to begin the session with accounting principles. So accounting principles, when we talk about, these are generally accepted accounting principles which are set of rules and practices followed while recording the transactions and preparing the financial statements. GAAP build sound theoretical foundation of accounting. The full form of GAAP is generally accepted accounting principles. As you all know, the business firms communicate their affairs and financial position to the outsiders through accounting in the form of various financial statements to make the language convey the same meaning to all the interested parties, to all the users of the accounting information, to all the stakeholders. It is necessary that it should be based on certain uniform, scientifically laid down standards. And these principles are termed as generally accepted accounting principles. According to the American Institute of Certified Public Accountants, which is AICPA, GAAP have substantial authoritative support and general acceptability. GAAP must be relevant, which is meaningful, objective, which is reliable, and feasible, which is implemented without much cost and complexity. So accounting is the systematized body of knowledge having cause and effect relationship. The subject has certain established concepts and conventions, standard language and terminology to enable the interested parties in the subject to understand. And understand in the manner which is same, and the sense of the standards in information should be same for accountants as well as for the users of the information. These rules are usually called generally accepted accounting principles. These are accounting assumptions, rule of recording and reporting business transactions, are also known by the term like concepts, principles, conventions, doctrines, tenets, axioms, postulates, assumptions, and modifying principles. The principles of accounting are not static in nature. They are constantly influenced by changes in legal, social, and economic environment, as well as the need of the users. Various terms for principles are interchangeably used by different authors. The term basic accounting concepts is used to refer all these terms. So talking about the principles here, now principles may be defined as rules of action adopted by accountants universally while recording accounting transactions. These principles can be classified into two categories. One, accounting concepts, and the next is accounting conventions. So talking about accounting concepts first. Now, accounting concepts, these are the basic assumptions or conditions upon which the science of accounting is based. So, when we are recording the transactions, we need to follow these assumptions. Now, these assumptions are very important in the process of accounting. We cannot prepare the books in a uniform manner if the assumptions are not fulfilled. So we have 9 accounting concepts. First one is separate entity concept. Then going concern concept, accounting period concept, money measurement concept, matching concept, cost concept, which is also known as historical cost concept, dual aspect concept, realization concept, objective evidence concept. So we are beginning with the first concept, which is separate entity concept. Now this concept says that the business is segregated and the businessman is segregated from the business itself. The concept of separate entities also states that the operations of the business and of its owners must always be recorded separately. This concept is most important when it comes to personal ownership, because this is the situation most likely to entangle the business with the owner's business. So therefore, when we talk about this particular concept, we say the owner and the business or the firm is separate. They are having two separate identities because of the law. So law has given the firm, organization, business a separate legal entity, and it is called artificial person. So when we have a natural person who is the owner, who is the creation of God, and we have one artificial person who is the creation of law. So therefore, if we talk about entities, we have two different entities now. So therefore, based on this concept, what we follow is the recording of transactions related to business will be done separately in the books of accounts of the firm, and the owner's expenses or incomes or financial transactions, they are not mixed with the firm's transactions. So they will be recorded separately and firm's transactions will be recorded separately. So according to this assumption, business and its owners are considered two separate and distinct entities. All the transactions of the business are recorded in the books from the point of view of the business, not from the point of view of the owner. Personal accounts of the owners or partners should be kept separate from profits and expenses of the company or the firm. Now moving on to the next concept, which is going concern concept. Now going concern concept, it says that the life of the business or the firm is indefinite, infinite. Nobody knows how much long a business will survive. So this principle presumes that the functioning of the company will be smooth and the business entity will continue to operate for a fairly long period of time. This concept is also known as so this is the going concern concept. Then we talk about accounting period concept. According to this concept, the life of the business is divided into equal time intervals, and each time interval is known as accounting period. Now we have spoken about in the last concept wherein we talked about the indefinite life of the firm, indefinite life of the business. So when we talk about the end result of the firm, of the operations, right? So we are talking about the profits and losses. It is impossible for everyone, each one of us who is running the organization, to wait till the end of the organization, wait till the end of the life of the business and then find out the profit and losses, which is impractical in nature. So therefore, what we have done is the entire life is divided into equal time interval, and each time interval consists of 1 year, which is 12 months, and these 12 months are known as accounting period. Now this period in India can be a calendar year, which is 1st January to 31st December, or it can be financial year, which can be 1st of April to 31st of March. So it is the period of 12 months. So this is known as accounting period. So according to the going concern concept, the business is intended to continue indefinitely for a long period of time. The users of financial statements need periodical reporting related to performance of the business. Thus, for reporting purposes, the entire life of the firm is divided into time intervals. In accounting, such a time interval is called accounting period. An accounting period is for 1 year. Now next we talk about money measurement concept. Now this money measurement concept indicates that monetary measurable events or transactions should be recorded in the books of accounts. The monetary principle states that the business transactions should be recorded if they are denominated in the currency. In other words, anything that cannot be quantified should not be reflected in the company's financial statements. Over time, money was adopted as a unit of measure in accounting. For example, owner's qualification and experience are not shown in financial statements. Otherwise, and likewise, human resource expenses are not shown in financial statements. So according to money measurement concept, only monetary transactions will be recorded. Only money related transactions will be recorded. Non-monetary transactions will be ignored. So according to this concept, only those transactions and events are recorded in the books of accounts which can be expressed in terms of money, such as purchases, sales, salaries, etc. Other happenings which are non-monetary in nature, like labor, managerial relations, sales policy, team of dedicated and trusted employees, etc., which are vital importance to the business concern, do not find place in the books of accounts. Next we talk about matching concept. Now matching concept, it says we are matching the cost against the revenue. And this is what the concept is saying. This concept is based on accounting period concept. So what we are trying to do in this concept is we are trying to find out the revenues of the year and the costs incurred during the year. So we are trying to match up the cost and the revenue and trying to find out the balance. If the cost is higher than the revenue, it would be a loss to the firm. And if the cost is lesser than the revenue, it would be a profit for the firm. So we try to match the two cost and revenues and try to find out the end result of the books of accounts. To ascertain the profit made by the business during a particular year, the expenses incurred in an accounting year should be matched with the revenue earned during that year. Then the sum of the cost should be deducted from the sum of revenues to get the net result of that period. So this concept says the income involved must match the cost. The matching principles requires that in the same reporting period, revenue and related expenses are recorded together and recognized together. Therefore, it is simultaneously reflects if there is a causal relationship between revenue and certain expenses. For example, royalty income for a period must match the royalty cost. Next concept that we talk about is the cost concept. Now this concept says the assets are recorded in the books of accounts at the cost which is incurred at the time of purchase of that asset. So the cost which is used for acquiring the asset in the firm will be the amount of asset or the cost of asset for all further calculations in the books of accounts. And if there is market price which may be higher, which may be lower, so we need to ignore the market price of that asset. So in case of land and building, since it always the appreciation which happens in the value of those assets, so therefore even if the value increases in the market, but we need to record the books, and the value which is to be recorded in the books of accounts would be the cost which is paid at the time of buying the asset, and all calculations related to the value of the asset we are going to do based on the cost that is incurred at the time of buying. So the cost concept says the price paid at the time of purchase is called cost. Under this concept, fixed assets are recorded in the books of accounts at the price at which they are acquired, not at the market price. This cost is the basis for all subsequent accounting for the asset. Then we talk about the dual aspect concept. Now, dual aspect concept says every transaction has two aspects. One is the receiving aspect, other is the giving aspect. So, if complete record of transaction has to be recorded, has to be made, it would be necessary to record both the aspects in the books of accounts. So, this principle is the core of double entry bookkeeping, and the system is known as double entry system of bookkeeping. So, both the sides would be recorded in the books of accounts, whether we are taking it or whether we are giving it. Then we talk about the realization concept. Realization concept is also known as accrual concept. And this concept says items and events are logged upon acquisition or use and not received or paid according to this. The concept causes open or prepaid items to appear in the financial statements. General concept of accrual accounting is that economic events are recognized by matching income and expenses at the time of transaction rather than when the payment is made or received. So revenues are recognized when goods and services are delivered and in an amount that is reasonably certain to be realized. There are two important dimensions to this principle. When revenue is recognized, we will record the transaction. When it is certain that the revenues will be collected, will be realized in the firm, then also we will record the transaction. So this is realization concept. Next we talk about objective evidence concept. The term objectivity refers to being free from bias or free from subjectivity. So what this concept tells us is every transaction which is of financial nature and is being recorded in the books of accounts must be supported with the physical evidences. Physical proofs has to be associated with the financial transactions. So evidences, it may be in the form of vouchers, it may be in the form of invoices. In case of all those transactions, for example, depreciation, for example, inventory valuation, where the physical evidences are not available, what we can produce is, we can produce the policy document which is there in the firm. These are the minutes of the meetings while deciding the depreciation policy, rates, inventory valuation methods, etc. So these would be the evidences which can be used at the time of the auditing, at the time of the production of various proofs and evidences. So for this purpose, all accounting transactions should be evidenced and supported by the documents such as invoices, receipts, cash memos, etc. As per the items like depreciation and the provisions for doubtful debts, there are no documentary evidences available. So the policy statements made by the management are treated as necessary evidence. So here we complete the concepts. Now we will talk about the conventions. Now conventions are the customs and traditions which guide the accountants while preparing the accounting statements. First and the most important convention is convention of conservatism, and it is based on the statement which is anticipate no profit but provide for all possible losses. So this particular convention says the loss which is seen from far should be considered for taking all kind of preventions to avoid that risk and uncertainty. But if we are having anticipation, if we are having expectation related to the profits of the firm, until and unless these are realized by the firm, until and unless these are actually received by the firm, they should not be accounted in the books of accounts. So this particular convention talks about if there is a risk which is foreseeable, can be taken care of, but if there is profit which is foreseeable, should not be recorded in the books in advance until it actually happens. So it ensures that uncertainties and risks inherent in the business transactions should be given a proper consideration. Profits are taken into account only when they are actually realized, but in case of losses, even the losses which may arise due to a remote possibility should also be taken into account. Next, we talk about the convention of consistency. The principle of consistency means that the same accounting principles should be used for preparing financial statements for different periods. Now, this principle basically focusing on the consistency in the use of various methods, procedures, processes. Now, for example, if we talk about inventory valuation, there are certain methods with which we can value the inventory. So if every year we are going to change the method as per our own will, there will be results, and these results would be vary in nature. So at the time of comparing the year on year performance of the firm, it would be very difficult for the stakeholders, because every time the inventory value will change as per the method that we are using. So therefore there has to be consistency which needs to be followed while preparing the books of account. So there should not be a change in the accounting methods from year to year. Comparisons are possible only when a consistent policy of accounting is followed. If there are frequent changes in the accounting treatment, there are little scope for reliability. Consistency principles enhances the utility of the financial statements. However, consistency does not prohibit the change. It does not mean that you cannot change the method. The method can be changed, but with proper reasons, with proper valuation, and the difference with the new method and the older method should be properly informed to the stakeholder. When a change is desirable, the change and its effect should be clearly stated in the financial accounts. Next convention we talk about is convention of full disclosure. It states that financial statements are to be prepared honestly and all significant information should be incorporated therein, because these statements are the basic means of communicating financial information to all the interested parties. Now, this principle is focusing on fully disclosing the information to the stakeholders. So these statements should be prepared in such a way that all the material information is clearly disclosed to the persons interested in its affairs, and it is therefore necessary that disclosure should be fair and adequate to have impartial judgment by the various stakeholders. Next convention we talk about is convention of materiality. Now this materiality convention focuses on that the material information should be fully disclosed. Now what is material information? Material information is relevant information. Relevant information or material information, it means that any information which changes the decision of the stakeholder becomes very important, very relevant information, and that relevant information should be informed to the stakeholders. So this is the convention which focuses here, and it is closely related to the full disclosure concept. Full disclosure does not mean that everything should be disclosed. It only means that relevant and material information should be disclosed. American Accounting Association defines the term materiality as an item should be regarded as material if there is reason to believe that knowledge of it would influence the decision of the stakeholders. So here we complete the conventions. So principles we have already seen, concepts and conventions. Now we talk about various accounting standards. Accounting standards are set of accounting policies and broad guidelines regarding the principles and methods to be applied in the preparation and presentation of various financial statements. So to ensure that there is uniformity in the accounting practices, and there has to be the comparison which is to be done by various stakeholders over year on year and between the company to company. So comparability of the financial statements. These accounting standards ensure the comparability, ensure the uniformity. Now Accounting Standards Board. It is constituted by Institute of Chartered Accountants of India ICAI on April 21st, 1977. And the main functions of accounting standards boards are to suggest areas in which accounting standards need to be prepared, need to be developed, formulate accounting standards, examine and to integrate Indian accounting standards with Indian accounting standards, to publicize, to persuade the concerned parties to incorporate it in the financial standards. So there are various accounting standards. Disclosure of accounting policies, valuation of inventories, cash flow statement, contingencies and events occurring after balance sheet date, net profit or loss for the period, prior period items, changes in accounting policies, depreciation accounting, construction contracts, withdrawn, accounting for research and development replaced by Accounting Standard 26, revenue recognition, accounting for fixed assets, the effects of changes in foreign exchange rates, accounting for government grants, accounting for investments, accounting for amalgamation, employee benefits, borrowing costs, segment reporting, related party disclosures, leases, earning per share, consolidated financial statement, accounting for taxes on income, accounting for investment in associate in consolidated financial statements, discontinuing operations, interim financial reporting, intangible assets, financial reporting of interest in joint ventures, impairment of assets, provisions, contingent liabilities and contingent assets. Now we talk about accounting cycle. Accounting cycle is a collective process of identifying, analyzing and recording the accounting events of the company. So we have seen in the previous video that there is a process of accounting that is there when we prepare the books of account. So accounting cycle is the same. Accounting cycle, it is a 8-step process that begins with the transaction when it occurs and ends with its inclusion of the transaction in the financial statement. The key steps in the 8-step accounting cycle include recording journal entries, posting to the general ledger, calculating trial balances, making adjusting entries and creating the financial statements. The accounting cycle is a methodical set of rules to ensure the accuracy and conformity of financial statements. Computerized accounting system and the uniform process of accounting cycle have helped to reduce mathematical errors. Today, most softwares are available which are fully automated, and they have automated the entire accounting cycle, which results in less human effort and less errors associated with manual processing. So we have already seen the process of accounting in the last video, and I am revising the same to you in the accounting cycle. So we start with identifying the transactions. We start with record transactions in the journal and posting the same into ledger, and then we try to make out the statement which is called the trial balance, and we prepare a worksheet analyzing the same and identifying adjustment entries which make up the 5th step in this cycle. The worksheet is created and used to ensure that the debit and credits are equal. If there are discrepancies, then adjustments will need to be made. And then what we do next is we adjust the journal entries. At the end of the period, adjustment entries are made. These are the results of corrections made on the worksheet and the results in the passage of time. And after the adjustment entries are made, we prepare the financial statements and we close the books of accounts. Talking about the system of accounting, we have two systems of accounting. One is cash system of accounting and one is mercantile or accrual system of accounting. So cash system of accounting, it is a system in which accounting entries are made only when cash is received or paid. No entry is made when payment or receipt is merely due. In the accrual system accounting, what we do is, this is a system in which accounting entries are made on the basis of amounts having become due or payment or receipts. So this particular system of accounting we follow, which is accrual system of accounting, we follow these nowadays. We do not follow cash system of accounting. So this system recognizes the fact that if a transaction has occurred, its consequences cannot be avoided and therefore should be brought into the books in order to present a meaningful picture of profit earned or loss suffered and also of financial position of the firm concerned. So this is the basis of accounting. I hope you have understood a lot of concepts, principles, standards, basis of accounting and accounting cycle. I hope you have enjoyed this video. All the best.